Over the past year, the performance of REITs has closely correlated with interest rates, and so when interest rates would go up, REITs would crash, and when interest rates would go down, REITs would then recover. And I've often pointed that this is extremely frustrating because it makes it seem as if REITs are at the mercy of the Fed and that they're essentially just a bet on lower interest rates. But in reality, this really isn't the case. And to prove this point, in today's video, I want to discuss 3 high-quality REITs that, in my opinion, really everyone should consider buying because they own great assets, they enjoy strong growth prospects regardless of what happens to interest rates, they have very low leverage as well, and yet their valuations are today heavily discounted. Hey everyone, this is Jussi. I run a small investment firm that specializes in REIT investing, and in today's video I'm going to discuss 3 REITs that we own at High Yield Landlord, which is my REIT newsletter. If you want to access our entire real money portfolio as well as our trade alerts in real time, you can join us for a 2-week free trial. I'll put a link to it in the description of this video. And before I get into today's video, I wanted to quickly remind you that we just recently launched a new YouTube channel that discusses all our favorite non-REIT investment opportunities. It's growing very nicely. We already have close to 3,000 subscribers. And if you haven't checked it out yet, I'll put a link to it in the description of this video. On this new channel, we're about to launch a new series discussing our top picks for the second half of the year, so you don't want to miss that out. Again, there's a link in the description of this video. So the first REIT that I think most investors should consider owning is called First Industrial Realty Trust. Its ticker symbol is FR, and this is really my favorite American industrial REIT today. I like it so much because it owns some of the best assets in its peer group, even better than those of Prologis in my opinion. It has some of the least leverage and it enjoys some of the fastest growth prospects, and despite that it's priced at one of the lowest valuations today. Since the beginning of 2022, it has seen share price drop by about 30%, even as it grew its cash flow by about 20%. And so what this essentially means is that its FFO multiple has now been cut in half. Right now it trades at about 19 times FFO, which may not seem particularly low to a lot of you who are used to buying REITs like EPRA properties at just 9 times FFO. But here you need to keep in mind that these industrial REITs typically trade at closer to 30 or even 40 times FFO because of 2 key reasons. Firstly, their rents are deeply below market today, and this is also true for First Industrial. And as its leases now gradually expire, it's able to bump up its rent on average by about 50%. So when you take that into account, the 19 times FFO really isn't that high because, again, this is based on today's cash flow, but if you bring the rents to market levels, this multiple would be a lot higher. It would be in the low 10s. And then secondly, these industrial REITs also own large land banks that, have a lot of value, but they're not generating any cash flow today because properties have not yet been built on top of them. They are not yet leased to tenants, but over the coming 5 to 10 years, as they gradually develop all of this land, it will start generating a lot of cash flow. And so again, if you look at today's FFO multiple, it's significantly underappreciating the true cash flow generation potential of these REITs. The REIT also has relatively little debt with a 25% LTV, long debt maturities, mostly fixed rate debt, so I don't expect any major impact from rising interest expense. Yet the rents are going to keep growing at a rapid pace. The company will also keep developing new properties at a positive spread relative to its cost of capital. So I expect its cash flow to expand very significantly already in the coming 2, 3, 4 years. And if the share price doesn't reflect that and rise to higher levels, its valuation multiple just won't make any sense already in the near term. It could drop in the low 10s. If we can also look at it from a different perspective, we can look at implied cap rates. Today it's in the 6, whereas these properties are really worth closer to a 5. So there's a discount to NAV, and if the share price doesn't rise to higher levels and it now bumps up its rents as leases expire, its implied cap rate will go into the 7th or even 8th, and that just wouldn't make sense for a REIT of this quality. And so I think it's very likely that share price is going to rise to higher levels. If it doesn't, this will become an ideal buyout target for a company like Blackstone. Hey, before I go into the second company, can you please do me a huge favor and click the like button? That will help me a lot to keep on growing. Thank you so much in advance. Then the second REIT I expect to also do really well regardless of what happens to interest rate is called Big Yellow Group. Its ticker symbol is BYG. This is one of my biggest European REIT investments today, and I like it so much because it's heavily discounted, it uses relatively little debt, it owns great assets with very attractive long-term growth prospects. It has historically managed to grow its FFO per share by about 10% annually over the past 20 years, and I just think that it can keep this going. The secret to its rapid growth is that it focuses on an undersupplied market with rapidly growing demand, and that's self-storage in Europe. This was by far the most rewarding property sector in the US over the past 30 years, as REITs were able to earn nearly 20% average annual total returns because there was little supply, and these REITs were able to build new facilities at high spreads of the cost of capital to meet the growing demand. But now the American market has become oversupplied, and Big Yellow is essentially replicating this exact same business model in the UK, which is still about 20 years behind the US. The demand is now rapidly growing in Europe in the post-pandemic world, as people are trying to make space for a home office, and they also bought a lot of toys during the pandemic and they need a place to store it now. And Big Yellow is in a great position to keep building these facilities at high initial yields of 8 to 10%, which represents a very big spread over its cost of capital. Therefore, I think that it should be able to keep growing its FFO per share at a very rapid pace. Historically, it grew it at over 10% per year on average over the past 20 years. Even if it falls short of that and just grows it by, let's say, 7% per year, you couple that with its 4% dividend yield, you're getting easily in double-digit total returns. And then on top of that, I think that the shares also enjoy some upside because they're today heavily discounted. The share price of the company has dropped by about 30% in this bear market, and despite the drop in its share price, has also actually expanded its cash flow by 20%. So once again, its valuation is still about 2 times lower than at its peak. I think that was a bit expensive at its peak, but it's too cheap today. The middle ground is likely somewhere in the middle, and that would equate to about 50% upside potential from here. And then the third REIT that I've been buying lately, this is one of our new investments at High Yield Landlord, is called Vesta REIT, ticker symbol VTMX. This is the only Mexican REIT that's listed on the New York Stock Exchange. It specializes in industrial properties in Mexico and is doing really well right now. Mexico is rapidly replacing China for the manufacturing of goods for American, Canadian, and European companies because of the growing trend of nearshoring, and I expect this to continue because of 3 key reasons. Firstly, Mexico is far closer to the end consumers of these countries, and this applies even to European consumers. Then secondly, labor is a lot cheaper these days in Mexico than in China, so it allows you to reduce your manufacturing costs. And then thirdly, and perhaps most importantly, China is a dictatorship, and over the past few years we've perhaps learned that dictatorships cannot be trusted as much as democracies. China is supporting Russia indirectly in its brutal invasion of Ukraine. It's itself threatening to invade Taiwan. It's working hand in hand with North Korea today. So Western companies now need to ask themselves, do they want to leave significant portions of their supply chains in China and potentially face the consequences down the line, or do they want to start diversifying their supply chains and perhaps bringing more of it closer to their end consumer? And I think that Mexico is a no-brainer here, and it's likely to keep attracting a lot of these companies over the coming years, and this will lead to rapid growth for industrial properties. And Vesta REIT is here to fill this void. It owns a large portfolio of high-quality industrial properties, and on top of that, it's now developing a lot of new facilities to meet this demand. And I think that here its listing in the US is a significant competitive advantage because it gives it access to cheaper capital, which it can then reinvest at a large positive spread. The company IPO'd last year on the New York Stock Exchange, and it raised a lot of capital in the process, which explains why its share count rose by nearly 30%. Today, it's still in the process of allocating all of this capital in development projects, and I expect this to significantly expand its cash flow on a per share basis in the coming years because it's able to target about a 10% initial yield on its new investments, yet its cost of capital is only about 6 to 7%, so there's a very large spread in between. This year, the company has guided to grow its NAV per share about $3, which is quite significant considering that the company's share price is only $27 today, so that's over 10%. And it has also guided to grow its FFO per share by about 20 cents, which again is quite significant. That's about 10% growth in just 1 year. And I just expect this strong growth to continue now because the company is still sitting on a lot of cash. It has a large land bank, a lot of new development projects underway that should expand its cash flow. It has relatively little debt as well, so it could expand its leverage in the coming years if it wants to be even more aggressive. And despite enjoying this attractive growth prospect, it's today priced at a roughly 20% discount to its net asset value, just around 14 times FFO. That's an exceptionally low valuation for a REIT of this quality, and therefore expected to do really well over time, really regardless of what happens to interest rates in the near term. In summary here, I want to say once more that REITs are really not just a bet on lower interest rates. Yes, it is true that we are hoping for lower interest rates because this should accelerate the recovery and lead to even more upside. But even if interest rates remain at these levels, I expect most REITs to do quite well because your average REIT really doesn't have much debt. Typically, they own Class A properties with attractive long-term growth outlook. The valuations are heavily discounted even if interest rates remain at these levels. Their valuations are really the lowest in over a decade relative to other asset classes like regular stocks, and this low valuation should help their returns going forward. They're offering high yields, and with these high yields you really don't need to achieve much growth to achieve double-digit total returns. I think that these three REITs, First Industrial, Big Yellow and Vesta, are three great examples of that, and this is really the type of REITs that most investors should be targeting. That's what we mostly invested in at High Yield Landlord, which is my REIT newsletter. Once more, if you want to access our full portfolio, you can join us for a 2-week free trial. There's a link in the description of this video. And also, I wanted to let you know that we just recently launched a free tier to our newsletter. We launched it on Substack. There's a bunch of free research there. So if you want to just check out the free research, I'll also put a link in the description of this video. Finally, if you thought this content was useful, please click the like button, subscribe to the channel. That will help me a lot to keep on growing. And let me know in the comment section below what REIT I should cover next. Thank you so much and see you at my next one. Bye-bye.